Do you know what I love? When the calendar flips each year, it's game on, you guys. It's strategy season. We got to ensure that we have some kind of a strategy in place so that we can meet our investing goals, right? Do a health check on your existing strategy, on your portfolio. Make sure that you're still in line with what you want to accomplish. And I know I personally need to do a deep dive and shed some positions so that I can become better focused and streamlined. So today, our goal is to talk about the strategy that we're putting in place for 2025. What's the goal? Well, we want to improve our financial health and pave our path to prosperity. So let's do it. If you guys saw my recent portfolio review, you know that I actually hit my 2024 goal of a projected annual dividend income, or PADI, of $6,000. I'm actually sitting at $6,282.15, which is great because that was my goal. But now this year, I need a new goal. It's time to raise the bar, and I'm shooting for $8,500 by year's end. Now, it might be a bit of a stretch, but I've got the drip turned on, so my dividends continue to purchase more shares each month. Now, based on my past performance, and here you can see a graph of my dividend income since I started this journey in 2022, I really think I'm going to have a solid 2025, and I should exceed my goal. Now, this next year is going to bring about a slight shift in my strategy because I really need to focus on streamlining the portfolio a little bit more and drop to fewer positions while increasing the overall allocation of my ETFs in the portfolio. So I'm really going to be driving that SCHD, SCHG core satellite scenario. That's what I want to do in my portfolio. But I need to keep it simple. 4-tiered strategy. And I wanted to share it because it might work for you guys as well. I don't know. Personal finance, you guys got to figure out what works. Step 1, you guys, is debt-free living. Or for me, continued debt-free living, which is now a way of life. But I wasn't always debt-free. I had amassed over $100,000 in consumer debt, and I had a mortgage. I was really drowning. But I'm proof that you can get yourself out of debt because in March of 2023, I can't believe it's been almost 2 years. It's crazy. Not only were we free of consumer debt, but we made our final payment on the house. And let me just tell you guys, it was a life-changing moment and continues to be. Not everybody thinks paying off their mortgage makes sense, and it may not for you, but it's personal for me, and being debt-free means a lot. Now, if you watched my recent I'm Back video, because I was on a little bit of a hiatus there for most of 2024, and you watch it to the end, you know that my family went through a pretty significant growth period in 2024, which necessitated us building a house within our house for our family because we had a couple of sweet blessings come into the world. Had I had a mortgage, we would really have struggled, but we were able to cash flow the whole project. Debt-free, no mortgage, good times. Okay, I digress. If you do have debt, I get it. It's overwhelming. I know how it feels, but just a little message from me to you, you're never stuck. You're never stuck, you guys. If something's not working for you, make a change, make a plan, propel yourself on the path to prosperity, whatever it looks like for you. If I can do it, you guys can do it too. Okay, back to strategy. Let me stay on the course here. A little tangential. Okay, anyway, step 2, consistency. And in my mind, there's 3 things that wrap up in consistency, 3 things that we need to be consistent with. Number 1, consistent portfolio additions. Number 2, consistent amounts invested. Of course, if you have more, always throw more if you can. And consistency with the criteria that you have chosen to select for your holdings. Okay, what the heck am I talking about? Let's start with consistent additions. Pick a day of the week. Maybe it's once every other week, or it's monthly, or if it's quarterly. Whatever you can do. Make a plan, stick to it, mark it on the calendar, and roll with it moving forward. Personally, I invest every Monday, if I remember when I wake up on Monday, when the market opens. But in addition, I do have an automatic deposit that hits my M1 account every day. I set it up. I decided on my allocations within my M1 pies, and then I can focus on other things or whatever squirrel runs by. You know, my family, making videos, because I'm back, you guys, writing, baking, all the things. So what I want you guys to do is commit to yourself. Commit to your future self because you're really, truly going to thank yourself later, I promise. The second part of consistency is the amount that you invest. If you've got a 401k, are you investing to get the match from your employer? It's one of the easiest ways to automate your investing. Just do it. Even if it's $10 a pay period, get something in place. Next raise you get, you can jack it up. Are you maxing out a Roth IRA? If not, set it up. Again, put what you can in it. One of the things I just did, had to talk to Mr. Hopeful about this, was I jacked up the amount we're investing into the M1 account from $50 a day to $55. I know it's only $5 a day, but it's $5 a day. Another thing for me, may work for you guys too, is that you automate as much as you can. We are more successful if we just set it and forget it. So if you haven't already, take a peek at your budget. Determine what you can invest and just automate it. The third part of consistency is the metrics that we use to add or remove a holding in our portfolio, right? What are you using? What are your guidelines to look at each of your holdings to say, okay, I'm keeping that, or, oh gosh, what am I doing? Why did I ever buy that? And that brings us to step number 3. If you already have an investment portfolio, step 3 is for you. If you're just getting started, step 3 is also for you. It's going to help you to develop your criteria for investing and getting into the world of investing. I did a video where I shared all the metrics I use in detail, and I actually applied them to my own portfolio to kind of show you what metrics I use to determine whether a holding is going to remain in my portfolio or if it's got to go. These are just some ideas. If you're looking for a starting point, remember, what I deem important may not be as important to you. So you've got to customize for where you're at in your life. Okay, here's the big rocks that I like to look at. Dividend streak, payout ratio, dividend growth rate. What's my total return look like, right? So if I take those dividends that I'm receiving and I reinvest it and whatever market appreciation there's been, what's that look like? What's the revenue growth of the company? What's their free cash flow looking like? So after accounting for all their expenses and investments in capital assets, how much money do they have left over? Because they need to have cash flow in order to continue to pay you your dividends, and we want those. Yield, that's based on your dividend rate that's established by the board of directors. The yield's going to fluctuate as the share price does. Share price goes up, yield goes down, and vice versa. So how high of a yield are you looking for? Or how low of a yield can you tolerate? Again, this comes to what you are looking for personally. And then PE, we look at PE, which is our price to earnings ratio. And this compares a company's current share price to its earnings per share, kind of helping you what you're paying for each dollar of earnings of that company. Another area I look at is the beta. And this is a measurement of the volatility of a stock compared to the overall market. So if there's a beta that's greater than 1, it's going to suggest higher volatility, while a beta less than 1 indicates a lower volatility compared to the rest of the market. So this is where you can kind of decide how much risk you're willing to take with each of your investments. A couple more, you guys. Current ratio, I also look at this, and this compares a company's current assets, like their cash, their inventory, to its current liabilities, so their bills and their short-term loans. And it shows the company's ability to cover its short-term debts with its short-term assets. So let's give an example. If we have a company that has $500 in current assets and $250 in current liabilities, the current ratio is 2, meaning the company has twice as many current assets as current liabilities. It kind of lets you know that the company might be in a good position to comfortably pay off any short-term debts that come up using its short-term assets. So a higher ratio generally is going to indicate for you that the company has a better ability to pay their current bills. Okay. Debt to equity. It's a financial metric that's going to compare the company's total debt to its total shareholder equity. A high debt to equity ratio. Imagine one side of the seesaw is much higher than the other. This means the company is using a lot of borrowed money compared to its own. This can help the company grow faster, but too much borrowing is going to make it riskier. So they need to regularly pay interest and eventually pay back all the borrowed money. Now, a low debt to equity ratio, picture that seesaw again, it's leveled or slightly tilted. And this shows the company relies more on its own money rather than borrowing. It's safer because they're not heavily in debt, right? You guys already heard me talk about being debt free. Yeah, that's where I want to be. I want to have a lower debt to equity ratio. But if the ratio is too low, like extremely low, it might mean that they're missing out on opportunities to grow their company by using borrowed funds wisely. Of all the metrics we just listed, you guys get to decide what are the parameters that work for you based on what the risk is that you're willing to take. And again, how much time do you have until you actually need to live off your dividends or supplement your income with them? Getting some type of framework in place that you're comfortable with is really important because it's going to allow you to be far more successful in step number 4, which I'll get to in a moment. But I want to share with you some of the benchmarks that I'm using in the year ahead with all these different KPIs to select or maintain a company in my portfolio. Okay. So for me, Payout ratio, 60% or less. Do I have some that are a little bit over? I do. But there's also a couple of exceptions, right? If we have any real estate investment trusts or REITs, or if we have BDCs, which are business development companies, they by nature of the structure of their organizations do have to have a higher payout ratio. Debt to equity, I'm looking for less than 1.5. 5-year dividend growth rate of greater than 10% is the goal. Do I have a handful that fall under that benchmark? I do. And this is part of I need to look at my own portfolio. I got to look at my own house and make sure my house is clean to see whether or not I'm going to keep some of these companies. So some of the ones that I'm watching, Chevron, Johnson & Johnson, Main Street Capital, Pepsi, Procter & Gamble, Raytheon, they're all under that 10% benchmark. I want companies that grow their dividends. Final step, which may be one of the most important, is to strip the emotion. I'm kind of a wild card sometimes, but I do my best to strip the emotion so I'm making concrete, pragmatic decisions for my portfolio. This is my future, right? And this is why those debt investors are the most successful. No emotions to get in the way of their strategy, which is just let it ride, right? Now, if you've established a strategy that you're feeling good about, you've done your research, it's working for you, don't waver from your plan, you guys. What milestones are you going to work towards? For me, I'm going to try to grow my projected annual dividend income to $8,500 for the year. And that would average about $700 a month in dividend income, which I'm feeling good about that. I'm hoping, Lord only knows what's going to happen with the market, but I'm hoping my overall value might hit that 180 mark. I'm sitting at 142 right now. I think it's feasible in overall value. I'm going to increase my core holding of SCHD to 1,644 shares. That's the goal. I'm currently at 1,384 and I'm adding 5 every week. And my newer position, because again, I'm trying to grow those ETFs in SCHG, I'm currently sitting at 184 shares and I'm going to add 5 more of that each week as well. So if my math is mathing, that's going to bring me to 100. Oh boy, my math is not mathing. But if my math were mathing, it would bring me to 444 shares of SCHG by the year's end. So that's my plan. What about you guys? What milestones are you hoping to hit? What's within your reach? What's your stretch goal? What's your game plan? What's your strategy? Lay it on me. Can't wait to hear. Okay. Until next time, guys, be well.